Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Neena Mishra. Stocks have been on a wild ride this year as investors navigate inflation, Fed rate hikes, and recession fears. And in fact, they have started the month of October with a bang, but many experts say that the worst may not be over yet. They want to still see clear signs of broad capitulation. And pessimism among individual investors recently reached its highest level in more than a decade. That is according to the Sentiment Survey by the American Association of Individual Investors, AAII. These readings are closely watched by many market experts, and in fact, some see these as the best sentiment indicator, and they are also often considered a contrary signal. So I have the perfect guest to discuss this topic this week. I'll be joined by Charles Rothblatt, VP at AAII and editor of the AAII Journal. So we'll talk about these surveys, and we will also talk about best ways to cope with downside market volatility, why it is very important for investors to stay invested. And since most AAII members are long-term focused investors, we'll also discuss how individual investors use mutual funds and ETFs in their portfolios, and Charles's favorite ETFs for long-term focused investors. I'm really looking forward to this discussion. Joining me now is Charles Rothblatt. Hi, Charles. Welcome. Great to have you on the show.
It's great to speak with you, Neena.
So to start off, tell us a little bit about AAII and your role.
Sure. So we are a nonprofit, the American Association of Individual Investors. We're a nonprofit actually founded by a professor at DePaul University, James Clunan. And our mission is to really empower individual investors to be better managers of their own assets. And so we offer individual investors a lot of education. We also offer them a variety of tools through our website, AAI.com. And I'm also, one of the things we do is publish a monthly magazine, the AAII Journal, of which I'm an editor. And putting the magazine together each month and each year, I really try to think about what challenges do individual investors have, what do they need to know, what questions arise. So we try to cover all aspects, obviously portfolio management, stock analysis, fund analysis, but we also get into things such as behavioral finance, retirement withdrawal strategies, some estate planning as well. So try to take more of a holistic approach, because obviously what goes into your portfolio really matters, but also how you allocate, the decisions you make, and even small things like just making sure your beneficiary information is updated has a big impact on your long-term goals. So we try to cover all of that.
Awesome. So let's talk about the AAII Sentiment Survey. Could you walk us through what exactly the survey indicates, how it is compiled, and also the latest survey results?
Sure. So we started the survey back in 1987. So we have about close to 1,900 weekly readings now. The survey itself has never changed. It asks AI members, over the next 6 months, I think stocks will be up, which is bullish, down, which is bearish, or relatively unchanged, which is neutral. The only thing that's really changed with the survey over its history is that we used to conduct a survey by mailing out postcards to all our members, and whatever postcards came back in a given week, that was the sentiment survey results. In the mid 1990s, we switched to making the survey online so members could just go on and vote. And it's just AI members who can vote. So we have this long history with the survey. And because we have this long history of the survey, we can actually get a sense for, oh, this is a pretty normal reading. this is, extraordinary, or this is just really unusual. And over time, it's developed quite a following, not only by individual investors, but also by institutional investors, by the media. I've occasionally gotten calls from hedge funds about it. So it's really widely followed. And as we record this right now, it's actually an interesting time because in our latest readings, and I will point out the survey itself runs from Thursday morning to Wednesday midnight, literally from 12:01 a.m. Thursday morning to 11:59 p.m. Wednesday night Central Time is a survey period, and anyone who votes during that time, their vote gets counted. And what we've seen this year, and even recently, is very low levels of bullish sentiment and very high levels of bearish sentiment. And I'll start with bearish sentiment first because our latest reading was at 60.8%, and this is for the last week of September. It was the first time that bearish sentiment has been above 60% on consecutive weeks in the history of the survey. So again, about 1,800 weeks, and we've only seen it. In fact, we've only seen bearish sentiment be above 60% 5 total times. So you had the last 2 weeks of September. You had August and October of 1990, which was the first Gulf War. And then the other 2 times were during the financial crisis. So October 2008 and March 2009. So pretty extraordinary times. On the other hand, when you look at bullish sentiment, in the last week of September, that was at 20%. And through the whole history of the survey, we've only had 50 readings out of approximately 1,800 where bullish sentiment or optimism has been 20% or lower. But this year alone, 2022, we've seen 12 readings of bullish sentiment coming in at 20% or lower. So extraordinarily low bullish sentiment, extraordinarily high bearish sentiment. And I think it just points to the uncertainty we're seeing over interest rates, the risk of inflation, the ongoing supply chains issues, and obviously the high level of volatility we've seen in the market. Through September, when you look at the number of days with a 1% move or a 2% move in the S&P 500 on a daily basis, not even counting just the intraday swings you're seeing, it's the most volatile year we've seen since 2020. And we're really on pace with the level of volatility we've seen in 2021. So I do think you're seeing this reaction among individual investors with just all the global uncertainty going on, plus all the volatility. It's certainly fraying their nerves and keeping their optimism about the short-term outlook for the stock markets low.
Right. This has been a very, very challenging year for stock market investors. And about your surveys, yeah, I totally agree. That survey is very closely watched by many market experts and financial media. And since this has been an extraordinary year, these extraordinary survey results were mentioned in all, financial media. And many say that these could be contrarian buying opportunities. Do you agree with them?
I do. And it's interesting when you look at sentiment, there's that old adage of to buy when there's blood in the streets. I would say buy when everyone else is fearful. And it is a little bit of a take on Warren Buffett's, old stance about being greedy when others are fearful. But when we just look at our survey, what we see is that the level of bull sentiment or optimism tends to be more of a contrarian indicator than the level of bearish sentiment or pessimism. If we take a look at bull sentiment, if you just map it on a bell curve, so in the middle, you have your average ratings, and then both sides, quote unquote, your tails on the left or right side, you have these unusually high readings, or use statistical terms, more than one standard deviation above or below average. That's when we tend to see outperformance. For instance, when you look at a 26-week basis, typically over the average 26 weeks over the history of the survey, we've seen the S&P 500 really have a median return of 5.5%. So it's been positive on a typical 6-month period as a typical return of 5.5%. When you look at what the S&P 500 has done following an unusually low level of bull sentiment, meaning one standard deviation below average, the median gain in the S&P 500, the median gain in the S&P 500 has been 8%. So a pretty big, much higher level of returns. And at a full year, a 12-month basis, you're seeing a median return of 16.4% in the S&P 500 when bull sentiment is unusually low versus 11% return for the S&P 500. So you really see the S&P 500 outperforming. Now, does it outperform every time bull sentiment is unusually low? No, it doesn't. And I think it's important to realize that sentiment, whether it's our survey, whether you're looking at investors intelligence, which maps newsletter writers. I know Bank of America has its bull bear indicator of money managers. It's not that sentiment itself is a causal driver. The markets don't rebound because sentiment's low, but sentiment's usually a sign that something else is going on in the markets. And it's usually a sign to take a step back and ask yourself, what's causing sentiment to be low? For instance, the record high in bearish sentiment was 70%, and that was in March 2009. In March 2009, everybody was fearful the stock market would fall into the abyss. Everyone thought the economy was going to fall into a depression. And that also turned out to be one of the best buying periods in a lifetime. People who got really greedy in March 2009 really made a large sum of money by benefiting from that large market return. So when you look at now, again, you have all this uncertainty about interest rates. We don't know what's going to happen in Ukraine. We don't know if Vladimir Putin's actually going to pull out a nuclear weapon or not. And again, what's going to happen with our economy? Are we going to fall into a recession? And if so, how steep is that recession? So when you have this uncertainty and you're seeing things look bleak, you want to start looking at stock valuations. And if stock valuations seem low, then maybe it's your sign that perhaps you either increase your allocation to stocks and maybe it's below average, or perhaps you consider just holding on to your allocation and not running for the streets, because at that point, maybe it's too late to actually be selling. You missed selling at the top, and now you're probably closer to the downside and further away from the top, which means just hold and wait for the rebound, assuming, of course, you don't have an immediate need for the money and you have no other reason but to pull money out of the market.
Very interesting thoughts, and I totally agree with you that these could be some very good buying opportunities for long-term focused investors. I was also interested in your thoughts on the recent market action, and we know that September was a brutal month for stocks, and that was one of the reasons for this extremely bearish sentiment that your survey recorded. And October has started with a bang on a very strong note. And for reference, we are talking on Tuesday, October 4th, in the afternoon. So do you think the worst is over, or do you think this is just a short-lived bear market bounce that could fade soon?
My crystal ball is still very cracked. But I do think it's fair to say when you look at September and you look at that big swing in the market, especially relative to April, it wasn't the individual investor moving the market. It was the quote unquote smart money. And I think a lot of traders and a lot of professional investors really found themselves looking silly. And I think what happened was they completely misjudged the Fed, even though Fed Chairman Jerome Powell was saying, we're going to keep raising rates, we're going to fight inflation, we're going to do what it takes to bring inflation under control. I think they underestimated his willingness to keep jacking up interest rates. And that certainly was one of the big causes for that big drop in September. Now, in early October, it may be a case right now where there's a sense that maybe they overcorrected in September, and now people are coming into the markets. We do know historically the fourth quarter has been a good year to buy stocks, but I think it's worth noting we're probably not out of the woods yet, but we never know when the sun's going to come out until it does. And often people who wait to get back in the market till they get that all clear sign turn around and wish they had actually bought sooner. So I don't know if we're at the bottom, but I have been saying for a while, my sense is given past bear markets and given how much the market has fallen, I would say we're probably closer to the bottom than we are from the top, meaning that when you look at the total decline, we've probably gotten a large portion of it. But again, where that actual bottom is and whether it's been reached or not, that's hard to say. Typical, the average bear market declines about 33%. Most bear markets since World War II have been actually had declines really in a 20% something range, which is what we're at. And obviously there's always fear about that big doozy, which is, you have a drop of greater than 40% like the financial crisis of 2008. But those tend to be a little bit less frequent than your typical bear market. And right now, this is shaping up to be a typical bear market. But obviously, that's still contingent on things in Ukraine not really spiraling out of control. And that's anybody's guess as to what Putin will or will not do.
Yeah, it's very difficult to predict what Putin is going to do.
Yes.
So let's talk about another survey which is very popular. It is the AAII Asset Allocation Survey. Tell us a little bit about this survey and the latest survey results.
Sure. So we've also done this since 1987. This survey is conducted monthly instead of weekly, and it asks investors how much they have allocated to stocks or stock funds, which is the equity allocations, bonds or bond funds, which is the fixed income allocation, or cash. And so we have a long history on that. And again, we get to see these long-term averages. And one thing that's notable about it, particularly this year, is although individual investor sentiment has been very bearish, our members are largely holding on to allocations. Even as for September, which recently came out, we saw individual investors having about 63.4% of their portfolios allocate to stocks. That compares to a long-term average of 61.5%. And even though it's down a little bit, what it tells us is that our members are continuing to stay focused on long-term investing, and they're really not paring down their allocations to equities. So what we've seen is that sentiment tends to be prone to big swings, which is common because people's emotions are very reactive. But we tend to see our members be less reactive with their asset allocation, so they're still holding on to it. On the bond side, we've seen that creep up a little bit. It's risen 4 out of the last 5 months. It's currently at 14.7%, which is a little below the long-term average of 16%, but not far away. And then cash, we're seeing that about 22%, which is also a little bit below its average, but again, not a huge move up. And so I think it's, again, just as I said, it really is a case of our members sticking to long-term allocations, which is what we encourage them to do. We're not fans of market timing, just because when you're market timing, you have to get the decision to get out of the market correct, and you need to make the decision of when to get back into the market correct as well, and have those decisions be correct enough that you're covering your transaction cost, you're covering any tax costs, and you're also taking in your behavioral risk on top of that, because there's always that chance that you'll make a mistake and you might have done better just trying to ride through the market.
So, did the survey results surprise you that investors are still sticking with that traditional sort of 60-40, not exactly 60-40, with some stock, bond, and some cash allocation? And I was also interested in your thoughts on traditional asset allocation. Do you still see a role for bonds in the portfolios, particularly in the rising rate environment? Are you telling your investors to have some allocation to commodities, other alternatives? And if your readers ask you whether they should have any allocation to cryptocurrencies, what do you tell them?
Yeah, no, those are good questions. So the asset allocation didn't surprise me because that tends to be more of a big ship and it tends to move more slowly than our sentiment survey. So that actually doesn't surprise me because we do see those trends going coming around the corner. So that doesn't surprise me. We do really tell our investors to really just focus on stocks, bonds, and cash. And for the average individual investor, just getting that basic mix right and getting it correct over the long term is really their biggest challenge. When we look at surveys of what investors do, Morningstar has a behavior gap study they publish every year that looks at what investors are actually realizing as their actual returns versus the returns of the very same mutual funds or ETFs they invest in. And there's commonly a difference, meaning that individual investors underperform the very same mutual funds and ETFs they're buying. And that's because of timing considerations. So I think individual investors need to get that basic allocation right. If they do and they're disciplined, there can be a role for commodities. They do tend to work as an inflation hedge. The challenge with the commodities, though, is really exposure and how do you get exposure because different commodity funds have different exposure. You get transaction costs into it, how the ETF, and also just how the ETF is managed. Are they using futures? Are they actually holding the actual commodity? And so there's a lot of moving parts below it because obviously you and I aren't going to buy a barrel of oil and stick it in our backyard. And then when we want to sell it, put it in our car and drive it somewhere. It just doesn't work that way. It's not that easy. So there are considerations with that. With crypto, I'm just not a believer in crypto. I heard someone recently say that a lot of crypto's value is because people are having to keep promote it. And if it really had value, you wouldn't see so much going into promoting it. And I realize there's probably people listening that are big crypto enthusiasts. If you believe it and you think it has stored value, there's a case to be made. I would just say allocate a small portion of your portfolio for it and have defined sell rules for it. But going back to the case of allocation, we have 3 allocation models on our website: an aggressive, a conservative, and a moderate. Our moderate portfolio is really a 60-40 allocation model. 60% diversified stocks, large cap, small cap, and mid cap domestic, plus international stocks. And then the bond side, we suggest holding intermediate term and short-term bonds. And even though interest rates have risen, bonds do provide income, but they also provide a ballast against stocks. So against that volatility of stocks, bonds are just going to move far less. Now, this has been a year where you have that traditional allocation mix of 60% stocks, 40% bonds. Both are down, but that tends to be, really tends to be unusual, not the norm. But I would say for those people who are concerned about bonds, you certainly can look at alternatives, Treasury inflation index securities. Perhaps you're really nervous, buying CDs with different expiration dates. You can do things like that. But I think it's important to realize that, again, bonds lower volatility. And the upside of bond prices falling is that yields are rising. So you are actually buying a bigger stream of income now with your bond dollars. But you do have to consider your tolerance for risk. and your investor horizon. If you're looking at 15 or 20 years and you can withstand the volatility of stocks, you should be mostly allocated to stocks and just ignore the market. Just have that allocation and let it ride, because you'll be very happy 15 or 20 years down the road that you didn't react right now.
That's very helpful and some excellent tips for long-term focused investors. I have seen that you write often about why investors should stay invested. And this is not easy, particularly when the markets are so volatile. So what do you tell investors to what they should do to ride out these market conditions and stay invested? Why it is important to stay invested?
One of the things I go back to as advice that Jack Bogle once shared with me. He said not to look at your portfolio for about 30 years. And then when you do, have the doctor on call because you might faint when you see how big your balance is. I still think that's a great, I still think that's just great advice. But, for a lot of people, they can't do that. And it's really hard. And I think for people worried about volatility, whenever there's a bear market, just really take our very volatile markets like we have right now with lots of downside volatility. So I think for a lot of investors, during a bear market, just to pull a sheet of paper, or perhaps they use their phone, the notes app on their phone, just write down how they're feeling. And if they're really nervous, then that might be a sign that they have too much exposure to stocks. But the other strategy that I like and I personally use is the idea of rebalancing. So having a certain range for your allocation to allow it to fluctuate. So, maybe your allocation calls for 60% stocks, or maybe it's 80% stocks, whatever's appropriate for you. Set a certain band of fluctuation. So, I, for instance, use 5 percentage point bands. So if my stock allocation falls 5 percentage points below where I think it is, I'll adjust my portfolio to bring it back to that target allocation. And the reason why I like that, it allows you to maintain your portfolio allocation over a long period of time. But B, from a psychological standpoint, it gives you something to do. And I think for a lot of people, even though they're told, don't act, just stand there, again, to a quote from Jack Bogle, that's not easy to do in reality. So to have a little thing they can do, obviously the alternative is that they're really nervous. Maybe you agree to just sell a certain percentage of your stocks. So maybe you sit down, if the market falls 20%, I'm going to allow myself to sell 5% of my portfolio. So you still get that emotional benefit of being able to know you sold something, but you're not wrecking your portfolio. And I love using dieting analogies because I think they work really well. If you're sticking to a diet, but you're allowing yourself a little dessert here and there along the way, you're probably more likely to stick with that diet over the long term than if you really restrict yourself from doing anything and not having those little things along the line that, that ice cream sundae or that really nice piece of pie. Because when you're constantly depriving yourself, sometimes it gets to be like a rubber band, and a rubber band just snaps and you've blown your diet. Versus if you allow yourself that little bit of give, you're actually sometimes a lot more able to stick with that diet. And it's the same thing with the allocation strategy. If you allow yourself a little give, a little bit of leeway, a little chance to sin, you might actually be in a better position to stick with your overall allocation strategy over a longer period of time, and therefore have better returns over the long term, versus if you just try to be this ideal model, highly disciplined individual investor that never flinches. Because at the end of the day, we're humans, and our minds really have not evolved to deal with the day-to-day volatility of the stock market.
Awesome. Love that diet analogy. So switching gears a little bit, I wanted to talk about ETFs. And I saw that AAII recently asked its members what traits are most important to them when selecting an ETF or a mutual fund, and what kind of funds they choose and why. Tell us what you found out.
Yeah, it was interesting. So what we found, a lot of members, there was a slight preference towards mutual funds and ETFs, and I think some of it might be just because they've held mutual funds for a long term, for a long time. Some are probably holding in 401ks. But what we tend to saw a lot of members talking about was just liking the fact that they could get instant diversification and widespread diversification with funds. They like the ease of getting that diversification, with a single fund or a mutual fund or a single ETF, with a simple purchase, you got that diversification. But they also like the cost. But it was interesting when we started talking to them and guiding them to talk about why specifically do you use funds. A lot of them talked about just having that broad allocation. Either they want exposure to an overall index, or perhaps they're looking at a sector and perhaps they saw a certain sector they thought looked attractive, but they really didn't necessarily understand the sector fully, or they didn't necessarily have time to really pick out the best stocks in a sector. They tended to use funds in that scenario, versus if they were looking at a sector and they really understood one or two stocks, or they had time to do that research, then they might own individual stocks. We do tend to see individual investors use mutual funds and ETFs more on the bond side than own individual bonds as well. And that really gets into, if you're an individual investor, it's a lot easier to buy bond funds than individual bonds. Because bonds, you typically need a large amount of money to actually buy bonds if you're not buying treasuries. We do have a small percent of our members who do buy bonds. It is possible to buy odd lots, but you do run into issues in terms of commissions, which are baked into the price you're paying for bonds. You also have liquidity issues where some bonds just don't trade for days. So while it's possible, it's a lot harder than buying individual stocks, where if a stock maybe has lower volume, maybe it takes 20 minutes, to get your trade executed on a stock that's not very liquid, versus on a bond that's not very well traded. You might be waiting 2 or 3 days or longer to get that trade executed.
Very interesting results. Now, I also wanted to ask you about your favorite ETFs for long-term focused investors. And I know that AAII members, most of your members are long-term investors. So what kind of ETFs are most suitable for these kind of investors?
When I tell investors, if they just want to just start, and I do get asked this, if they just want to start out, I think it's just going with a broad market fund works really well. And I think the big key is just getting low cost and portfolio diversification. On the stock side, I'll give two I personally own. One is the Invesco Russell 1000 Equal Weight ETF. That ticker is simply EQAL, so equal without the U. And that takes a Russell 1000 index and it equal weights it. And what I like about equal weight indexes is that every stock in the ETF or even within the index, every stock has approximately the same equal weight. So if you look like an S&P 500, Apple really has a big influence on how the S&P 500 moves, as does Microsoft, as does Google, as does your very large mega cap companies. With an equal weight ETF, a company that's smaller, say like WEC Energy, which is a power company in Wisconsin, which is part of the S&P 500, but chances are a lot of people don't know what it is. That tends to have a very small influence. An equal weight index balances it out. And over the long term, you do tend to see better returns for equal weight strategies. But the other option is to just go with a broad market cap index. And in a fund we actually hold in our IRAs, my wife, is the iShares Core S&P Total Market US Market ETF, which is ITOT or ITOT. And this holds about 3,600 stocks. So it gives you very broad allocation to large cap, small cap, mid cap stocks. And the nice thing about the ETF is you're basically buying the entire U.S. stock market, and your expense ratio is 0.03% expense ratio. So basically, for every dollar you put into it, you're paying 0.3% of a penny to own the fund. So extremely low cost. And what we tend to see with ETFs and with mutual funds is generally cost matters a lot. And the lower you get your costs down, the better. So I think for someone who just wants a simple solution, they work really well. But I do think it's possible also that you could look at things like small cap value ETFs to supplement those. When you get a small cap ETFs, I think it's really important, or even mutual funds, it's really important to look at what kind of small cap stock they're holding, because some are larger than others. For instance, in my 403B, I have the S&P 500. I have the Vanguard small cap value ETF mutual fund. I'm sorry, I don't have the ticker right in front of me. It's just a Vanguard small cap value. But that has an average market cap of about 6.6 billion. So it's small relative to large cap, but still not really small. And I will suggest on the bond side, people who are concerned about the bond market, Fidelity, Invesco, and iShares also own defined maturity bond funds. And I like these because they're hybrid bond funds. So they actually have a maturity date like a bond fund. So if you buy one that has a maturity date of 2027, this ETF will mature and you will get the net asset value of the ETF paid back to you at maturity. And so in this case, you can buy some are actually give you exposure to emerging markets. Some give you exposure to municipal bonds. Some give you exposure to corporate bonds. The Fidelity defined maturity bond funds or mutual funds. iShares and Invesco give it to you in ETF format. But for someone who's concerned about interest rate risk, I think those are kind of nice because you can actually ladder your maturity, and that takes some of the timing aspect out of it. But it is a hybrid vehicle, so it's not quite a bond fund, it's not quite a bond. You're getting some compromises, but I do like those as hybrid vehicles. And Nina, if I could just throw in one other thing,
Sure.
for the average investor who has a 401k plan and they're not certain about their asset allocation, that default allocation of a target date fund works really well. It's not perfect, but you could do a whole lot worse than just having a target date fund and just leaving it alone. For someone who doesn't know anything about asset allocation, it's a good solution. Can you do better? Yes, but you can also easily do a lot worse than that.
Excellent stuff. That's all we have time for today. Charles, thank you so much for joining us today and for sharing your excellent insights.
It was great talking with you, Nina.
So that was Charles Rothblatt from AAII. So let's quickly recap the two equity ETFs that he mentioned, because I think those are excellent picks for long-term focused investors. The first one is iThought. It is by iShares. iShares Core S&P Total US Stock Market ETF. So this provides exposure to the entire stock market, entire US stock market, mega caps, large caps, mid caps, small caps, micro caps. You own the entire market, and the expense ratio is just 3 basis points. Very, very popular with investors with more than 39 billion in assets under management. And top holdings are Apple, Microsoft, Amazon, Tesla, and Google parent Alphabet. As you would expect, the ETF is top heavy. All market cap weighted ETFs are. So those the tickers that I mentioned, they account for almost 20% of the portfolio. If you're concerned about concentration of your ETF in just a few names, then the other ETF that he mentioned is great to consider. This is Invesco Russell 1000 equal weight ETF. So this holds all Russell 1000 stocks in equal weights. So very interesting weighting scheme. So slightly more pricey because of this specialized weighting scheme. It charges 20 basis points and has about 560 million in AUM. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. And also make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.